The existence of a Fed was something that Charlie Munger generally supported. He believes that in a world with stable currencies, we require central banks with sound judgment. If you were to take a glance at Japan in the present day, you would see that the country's central bank has been reduced to the status of a squeaky mouse by the federal bank. As a result of this, we now understand that central banks may be a really important institution and that if you put them in sufficient danger, you can force them to grant you great access. Therefore, Charlie Munger favors those who work for central banks, and he despises those who advocate cryptocurrencies like Bitcoin. We haven't been forced to put it into practice yet. Charlie Munger is of the opinion that the Federal Reserve is willing to endure a modest recession so as to avoid relying on other methods to manage inflation. They are meant to be the one man at the party who doesn't hang around the one punch and instead gets drunk. He believes that we were already in a significant amount of difficulty when this whole thing started, and that if the Fed hadn't done what it did in such an aggressive manner, we would have been in a hell of a disaster that is far worse than what we have today. The Federal Reserve of the United States, also known as the Fed for short, has been the focal point of attention over the past couple years. This attention has not been positive, however, as many people blame the Fed for the highest inflation the United States has experienced in the last 40 years, as well as the slowing economy. Those of you who may not be familiar with the Federal Reserve may not know that in addition to determining interest rates and managing the money supply, the Fed also helps regulate financial markets. The Federal Reserve Board made some genuinely extraordinary moves at the beginning of the year 2020. Because of the widespread closure of businesses across the country and the sudden loss of employment for millions of people, the Federal Reserve decided to cut interest rates to an almost insignificant level in an effort to prevent the economy from entering a state of economic collapse. By reducing interest rates, the Fed made it cheaper for companies and people to borrow money, which they could then use to spend and contribute to the expansion of the economy. The combined effects of these enormous government stimulus initiatives served to keep the economy healthy and prevented the economic catastrophe that most likely would have occurred in the absence of these programs had they not been implemented. Charlie concluded that he needed to take this step. On the other hand, the Federal Reserve may have made a mistake by delaying the process of returning interest rates to more normal levels for too long. The Federal Reserve kept interest rates at their current level of 0% throughout 2020 and 2021, despite the robust state of the economy. Here's a concept to help you picture the Federal Reserve's work. To illustrate this, let's pretend there's a party with hundreds of excited revelers. Think about the greatest tasting alcohol drink ever mixed into a big punch bowl that has an infinite supply. Things are bound to get a little out of hand as the night progresses, and everyone keeps partying and having a great time while drinking more and more out of that punch bowl. Prior to it being too late and irreversible, the Fed must be the one to intervene and remove the proverbial punch bowl. When 2020 and 2021 rolled along, the stock market was a raging good time. The stock market had begun to recover, and numerous stocks were once again making headlines. Stocks with low sales and no clear route to profitability were selling for exorbitant prices as day trading gained popularity again. There was a talk that Warren Buffett and Charlie Munger were becoming irrelevant because they had chosen to sit on the sidelines. The general feeling is that stock prices can only go up from here. If we return to our punch bowl analogy, we can say that the hangover will be more severe the longer the bowl has been sitting out. In fact, that's exactly what the economy is showing us now. The consequences of leaving the punch bowl out for too long, the highest level of inflation in decades, is the main worry of the American people. As a direct consequence of this, the Federal Reserve is aggressively raising interest rates in an effort to curb inflation and make up for the time that has been lost. As a result of the Federal Reserve's decision to raise interest rates, obtaining loans from financial institutions will now be more expensive for consumers and commercial enterprises. When interest rates go up, consumers will pay more for loans like their homes, cars, and furnishings, as well as consumer loans for things like refrigerators and washing machines. This means delaying renovations or purchasing fewer new machinery than planned for businesses. Raising interest rates helps lessen demand in the market as a whole, which in turn should alleviate some of the upward pressure on prices. One significant disadvantage is associated with making an effort to bring inflation under control. The Federal Reserve is attempting to strike a balance. On the one hand, they aim to ensure that they slow down the economy to the point where inflation returns to more normal levels. However, at the same time, they want to ensure that they don't drive the economy into a terrible recession by hiking interest rates too soon or excessively high. The Federal Reserve has officially stated that it will do whatever is necessary to bring inflation under control. The chairman of the Federal Reserve, Jerome Powell's job is analogous to that of a pilot attempting to land a huge plane on a short airstrip while the weather is terrible. There are two possible outcomes to this situation. The first type of landing is known as the soft landing, when a central bank aims to raise interest rates just enough to prevent an economy from overheating and experiencing high inflation while simultaneously avoiding a catastrophic downturn. The goal of the central bank is to achieve what is known as a soft landing. Another possibility is that the outcome will be very bad. For instance, if the Fed tries too hard to stop inflation, it could lead to a bad economic downturn. If the economy had a hard landing, people would lose their jobs, businesses would close, and the value of assets like stocks and real estate would go down. As amazed as Charlie Munger was that Tesla did it, he was just as shocked by what Elon Musk announced. While he acknowledges Tesla's contributions to the field, he does not consider him on par with Bitcoin. It upsets him to see people who were once well respected in my nation aiding and abetting such organizations, promoting their golden goose, etc. Though he acknowledges that you are witnessing a lot of delusions, he maintains that people truly mean good. It is a combination of trickery and wishful thinking. Not a good pairing at all. Neither honesty nor delusion is to his liking, and he views delusion as potentially more dangerous. Understand the key contrast between what Charlie Munger considers a productive asset and a non-productive asset to get a sense of why he dislikes Bitcoin and cryptocurrencies in general. An asset is considered productive if it creates cash flow beyond the eventual sale of the asset. Let's just imagine you own a farm. At the end of each year, that farm will have grown crops for you that you can then sell and convert to cash. You will have both a large sum of money and the farm as an asset each year when the fiscal year concludes. The same is true for an apartment building. At the end of the year, you, as the owner of the apartment building, will have received rent from your tenants, and you will still own the building. Another illustration would be stocks. Buying stocks is similar to taking a modest ownership stake in a company, with the expectation that the company would provide cash flow from which you will benefit. If you're following along, these examples are leading you to the same conclusion. In general, an asset's worth is measured by the amount of money it is expected to bring in over the course of its useful life. Non-productive assets are things that you can only make money from by selling them for a higher price to someone else. This is shown by gold and silver. You buy an ounce of gold, and as long as you own it, it doesn't do anything for you. You have to pay what the asset is worth on the market. Your only chance is that the asset's price will go up over time. The only time an asset that doesn't make money for you will do so is when you sell it. This is why Warren Buffett's productive asset will almost certainly make more money over time than an asset that doesn't make money. Bitcoin is a type of asset that doesn't make money. Charlie Munger's claims that Bitcoin has no value got a lot of attention in the news. He says Bitcoin is worthless because it doesn't do anything for the person who owns it. Since the value of an asset is how much money it will bring in over its lifetime, how do you put a price on something that doesn't bring in any money? What do you think of what Charlie Munger merely informed us? Do you agree with him as well? We'd like to hear what you think about this, so please leave a comment below.